Okay, this is the November 2014 U.S. stock market forecast. So here I'm going to talk about the Dow and the NASDAQ and probably briefly the S&P. So October 10th, November 7th. October 10th was the last day of the market forecast. October 10th was when we did the analysis in October. So since that time, we can see Dow obviously rallied very strong. And it's up just under 17.6, right? 17,600. We nailed the bottom again. Once again, the important thing was not nailing the bottom. The important thing was not predicting the sell-off. The important thing was that we said, hey, here's where you want to buy. Even if we missed that period, even if the rally occurred at 17,000, right, or occurred at 15.5, 15.6. The bottom line is that we felt that it would be a continuation of the bull market. That's the important thing, okay? And the reason why I talk about that is that think about it for a second. Think about if, in fact, let's go back to this other chart from video 1, all three markets. Let's think about, I don't know, say, okay, so 5 years ago, well, let's look at 2 years ago. Let's say here in September, okay, when I forecast this down period, this sell-off and buy-in period here, let's say that I said, well, you know what? I think this is going to be a bear market. I think this is the beginning. And then I kept you out of the market, right? I was waiting and waiting and waiting, and what happened? Went up, up, up. Then what happened? Oh, we got a sell-off. Oh, okay, this is it. This is it, folks. This is the bear market. What happens? Rally. And this is what a lot of people have done, by the way. Although they haven't really predicted the sell-off. They've been predicting a sell-off every single month, right? And then they see it go down. Oh, yeah, the market's going to collapse, right? And what's happened? You would miss out on all these gains, right? So my point is that even if you're just a passive investor, and you don't even really do much adjustment to your portfolio, you may just have a Vanguard S&P. The important thing is that you're using this research because when everyone's panicking, when the market sells off, it doesn't bother you. You might decide to add more because I've said the bull market's going to continue. This is a buying opportunity, right? So fortunately, I've been right in both aspects. I've nailed each of these forecasts from top to bottom pretty damn accurately, I think it's fair to say. More important, the second component, the primary component, is that I've continued to forecast a bull market. So I want to continue to emphasize that because you can't lose sight. Don't lose sight of those two aspects, okay? It's easy for some numbskull to come out and say, oh, the bull market's going to rage. It's going to continue. Just like it's easy for someone to say, oh, the bear market's going to continue. It's going lower, right? A few years ago. Those people they're not market forecasters. They don't know what's going on. It's very difficult to shift gears, okay? It's easy for someone to keep calling for upside in the market over and over and over again because that's basically the path that they take, or the doom guys. And you've also got a third category of people who are knee-jerk guys, right? They call for a bear market at the lows, and then when it rallies, they change their mind. Oh, I was wrong. You follow these guys. You just ask to get slapped in the face back and forth. And those guys are all throughout the media, all three of those categories. So I just want to give you a flavor for that because at the end of the day, you got to understand what forecasting is and what it's not, the expectations and what the true value is. And the true value of the forecasting is going to be different for different individuals. Some of you are financial advisors, right? For you, and you may not be active managers, but for you, you can hold your client's hand when they call up and they're panicking and they've been brainwashed by what they've heard in the media. You can say, listen, don't worry. Here's the deal. For other financial advisors, you may have a more active approach. You may be independent and you may be more hands-on. This will help you manage some of the portfolios of some of your more active clients, or maybe you have two or three different funds that you use, right? Fund managers, of course, you know how to use all this stuff. I don't need to even speak to that. Let me go on now and talk a little bit about these indexes. Earnings are strong, but I'm seeing some things to be concerned about, and the risks are certainly out there, and they're not decreasing at all. So remember, don't try and time the market exact top, exact bottom. If you try and time exact top and exact bottom, you're going to get blown out, or you're going to miss the opportunities. Okay, and that's why I say you want to start looking at selling. Selling into strength. And some of you, by the way, this doesn't apply to. Some of you don't need to trim because you either have plenty of cash on the sidelines, or you got plenty of cash coming in on a constant basis, or it just doesn't apply to you. Okay, for whatever reason. But in general, this is kind of a median, an average type of asset allocation risk management strategy. It's overall. But some of you it's not going to apply to. Just keep that in mind. And once again, learn to separate my market forecasts from the market forecast integrated with the investment strategy and risk management strategy, because certain assumptions are made when I try to integrate those components. But what you should focus on, this is called market forecasting. I'm providing you the bonuses. But at the end of the day, the market forecast is what you should be focused on. I can't determine what your risk level is, what your skill level is, how aggressive, how passive you are, your risk tolerance, so forth. But I am providing a general gauge for kind of an investment strategy for you. You can tweak that. You can customize it. Some of you want to hold off. If you're more aggressive, if you're more active, you're not going to be wanting to sell, right? You're going to want to wait. You're going to want to wait towards closer to that Thanksgiving, see how we're going. You're going to want to wait going into December, right? Because once again, you'll recall, I talked about and I've written about actually I think in the November opening statement, part 1, part 3, one of the two, talked about where market's going higher, right? I felt the market's going higher, but at the same time, I'm saying, hey, you want to start selling. Why? Because you don't want to react all in one move. And I'm not here to guide you every day, right? So it's just something to be thinking about. You decide when to pull the trigger, okay? With that, let me go ahead and start talking about these 3 indexes. But for the most part, nothing has changed. Okay, nothing has changed. Review the October forecast if you want to get a good understanding of what's going on, because the support and resistance levels from that forecast from September, from August, they're pretty much the same. Nothing has changed. October 10th to November 7th, you can see the NASDAQ outperformed the S&P, which outperformed the Dow in light blue, right? NASDAQ green, S&P red, Dow light blue. And this has been a trend that we've seen over and over again for the past few years, right? 3-month chart. Last month, and this was October 10th, this period, the 2-month forecast period, actually maybe 3 or 4 months, is a little bit complex because a lot of this depends upon the timing, right? We release these market forecasts within 48 hours of the second Sunday of the month. Typically, we release it on Sunday or Monday, the second Sunday or Monday of the month, right? So we don't basically release these when we think is the most optimal time. Sometimes we get stuck in the middle of a trading cycle, right? But we have to report what we see. So this is a particular period here whereby we were kind of in the middle of this. We felt things were going to go lower, but we did predict this downside in September, right? You'll recall. September forecast. The September forecast was based upon the data from September 5th. I believe that was the Friday, and then Monday, September 8th. So that's when you had a chance to respond. And so you recall, we forecast a correction or a sell-off down to 16.4, 16.6. That's kind of the range, 15.5 being in the middle. And we did, as you'll recall, discuss that there was a fairly not equal, but, it wasn't like 80, 90% at that range. We were kind of like, 45, 50%, 55% around that range, although I don't think they gave specific percentages. But we also saw that 16.2 on the Dow down to 16 also was somewhat of a possibility, but not quite as high. We were focused on that mid 16 range, and that's exactly where it fell by the time we were ready to do the October forecast, right? And we also mentioned that we didn't want anyone to get in to that sell-off. If we did get the Dow 16.4-ish, right, or 16.5, we didn't want you to get into that, to buy into that, unless you were aggressive. Didn't explain the reasoning why, but the reason why, as we explained later, was because we felt that we would get this rapid rally and then cycling up and down, which would result in lower highs and lower lows. And we didn't want the less active individuals to get stuck into that. Okay? So now you understand why we talk about more aggressive. More aggressive means more active, right? You're following this stuff on a daily basis. You're more of a shorter term or swing term trading, right? As it would turn out, October 10th, we said we're going to have more downside, and we were looking at the 15.8 to 1600. That's exactly where it went, right? And there we said everybody should get in. The more aggressive don't have to wait as much, but because it was an irrational sell-off, it was different than before. Irrationality can take things down to levels you can't even imagine. So we want to wait for signs of bottoming. We want to wait for signs of upside before we get in. That's how you play irrational behavior. Okay, unlike all the other forecasts in at least the past 3 years, this one was different. So remember this as a learning point, okay? And look back how this played out. There was no real trigger to this, right? It wasn't a specific trigger that caused this sell-off. So what do we see? Nailed the bottom. Exactly. Boom. Huge upside. Okay, so this is a chart from the 15th of October through November 7th. So far, we're looking at an upside in the NASDAQ of just under 10%, S&P 9%, and the Dow just under 9%. So pretty much a 10% pop. That's 3 weeks. I mean, that's good enough for a year performance. You understand that, right? Typical performance in the equities markets, long term, including, large cap, small cap, mid cap, is about 7%. Okay, maybe 8% if you include dividends, but in general, I think 7% is a good conservative estimate. And so, irrespective whether it's 6%, 7%, or 8%, the bottom line is in 3 weeks you had the opportunity, and it was pretty obvious, I think, to get into there. You had the opportunity to, let's say, to nail 7% or 8%. That's good enough for a year return. And this is, I believe, the 4th time or the 5th time we've done this year. Okay? That's the importance of market forecasting from one perspective. From one perspective. The most important perspective, however, is to understand our forecast that this was going to sell off. Not exactly if it was going to, even if we missed the bottom, if we were far off from the bottom, the most important part of the forecast was, hey, it's going to be just a sell-off or a normal retracement. It's not going to be the beginning of a bear market. And it's most important because for those of you who are more passive investors, or even the most active investors, you need to have a passive portfolio as well. Right? You have to have a passive strategy, at least for some of your positions. You can't be just trading aggressive everything, or that's very, very dangerous. You don't want to do that, right? So everyone should have somewhat of a passive portion of their portfolio or different account, okay? That's just the prudent way to invest. So the most important aspect of the forecasting is to say, hey, when everyone's panicking and everyone in the media is panicking and saying this is the beginning of the bear market, oh my God, and all these numbskulls in the media basically came out on the exact bottom, the 15th or the 16th, and said, oh my God, this is the bear market, causing people to sell at the exact bottom. You weren't worried. You were laughing because you said, well, listen, Stathis has been right all this time, all these years, every time. He not only has nailed the sell-off, he's nailed when to get back in. So Stathis might be wrong this time, but you know what? I'm going to take the chance. I'm going to play the odds because I'm a long-term investor. Long-term investment doesn't mean buy and hold, because buy and hold means crash and burn. Long-term investing means you're committed to the process. Okay? You're committed, and you found somebody, or you've developed some strategy, methodology, which you're continuously refining, that you know for a fact is providing you with better results than flipping a coin, right? So it's a numbers game. If you found some source, including yourself, or including some strategy that works for you and it's working more times than not, then it's a game of longevity, right? Because if you keep a consistent basis in that, if you keep following that strategy or that individual, that research, you're going to win over time. So even when the period that I am wrong, don't sweat it. I'll sweat it more than you, believe me, but you shouldn't sweat it, because you need to look at my track record, my performance, and understand that I'm not perfect. I'm human. And once again, as well, forecasting is not about providing a crystal ball forecast. It's about providing the scenario analysis, a risk-adjusted mechanism or variety of scenarios based upon what's going on, right? It's a guide. Okay, it just so happens that the forecasts have been spot on, but I'm going to miss forecasts, right? Hopefully, I will never miss the risk-adjusted insight and to provide you with these things to consider. I'm sure I will at some point, but that's what I really want to nail. But when I miss a forecast, that's just the way it's going to be, right? You have to look at the numbers game. How many times have I been right? So, and I specifically mention this because it's inevitably what's going to happen is I'm going to get some new subscribers at some point, and they're going to be expecting me to nail everything. They've heard about me. They may have seen some of the videos showing the forecasting, and they think it's just automatic. It's that easy, right? And they're going to put everything they have. They're going to jump into the market, and you know what's going to happen? That's going to be the time that I'm wrong, that I miss things, or things didn't pan out, or something happened that was unforeseen, right? Which doesn't necessarily mean that I was wrong, because I don't have a crystal ball. Things can happen, right? And those people, if they're inexperienced, which most likely they are, if they're jumping into the market full force, they're going to look at me and say, well, gosh, why did you do this? Look at you, you're clueless, right? More experienced investors understand. So it's about expectations. You got to understand the expectations of what's going on. And I wanted to talk about this because I know some of the older subscribers, I think you're spoiled. Don't lose sense of reality. As a matter of fact, some of you, I think it's a good idea to also subscribe to some other people's research that do market forecasting. Not because their information is going to be worth a damn, but it'll give you an idea to see how difficult it is. And you need to get their back issues as well. Get their past few years and see what they've done. You'll understand then, because I can tell you right now, market forecasting, very, very, very few firms, individuals try to even do it, because it's arguably the most difficult thing to achieve with consistency. Okay, so anyway, enough of that. Sorry, I just wanted to give some of you a better perspective on how to view these things. I'm not trying to prepare you per se for any misses I might have. I want to make sure you're grounded and you have the realistic expectations. Okay, that's why I provide you with all this supplementary information, because you need to act on your feet. Remember, once a month we're giving you these forecasts. A lot can happen in 30 days. Okay, that's why I try to arm you with all these things to help you adjust, to react to situations that may arise that come outside of the assumption sphere that I have created that goes into making these forecasts, right? Anything can happen, right? We could have a bombing of the New World Trade Center or something like that, right? Well, what would happen in my forecast? Obviously, they wouldn't come in accurate, okay? Any of those things can happen. That's what you always have to keep in mind. That's why it's best to have a running understanding of what's going on with the previous forecast, because you can understand the support, resistance levels. You can understand what's going on in the economy, the risks, and so forth. So, 3-month chart, you can see filling the gap. Now, the S&P is the weakest of the three in terms of filling and holding that gap. But still, all of them have filled the gap and blown past it. Very bullish sign. Very bullish sign once again. And you can see the Dow is the most grounded, followed by the S&P and the NASDAQ. And this, of course, reflects, in my opinion, the relative excessive valuation that we're seeing in the NASDAQ and a little bit in the S&P as well. And then once again, so you can see here over the year-to-date chart that the NASDAQ and the S&P have diverged from the Dow, right? And you do have some bubble behavior, especially in the NASDAQ, early stages of the bubble. S&P's got some remnants of that because you've got some social media trash and some other garbage in the S&P as well as the NASDAQ. You're not going to see that trash in the Dow. Keep that in mind. In the 1 year chart, you can see the volatility spike, right? And of course, we did forecast that increased volatility several months ago. Of course, increased volatility means in both directions. We felt it was going to be on the downside, and that's exactly what happened. And this is a 2 year chart, and very bullish, right? And then the 5 year chart. And so you can see even the NASDAQ, which is blown away the other two indices. This is from 5 years ago, and November 9th, 2009 to November 7th, 2014, you can see it's only up 113%. I shouldn't say only, but only is because I'm comparing it to the exact bottom, which is probably 250%. Let's take a look. Okay, so that's March 9th, 2009. Okay, I was close. 265% for the NASDAQ. S&P just under 200%, and then the Dow just under 170%. Okay, so the point is that when you hear this stuff, wow, the NASDAQ's up 265% since the market lows, and the S&P is up 200%. If you look at your portfolio, it's like, gosh, I'm not doing that well. No. When did you get in? Did you get into the exact bottom, right? No. So if you got in, 2 years ago, it's only up, NASDAQ 60%, S&P 47, Dow 37. Okay? Keep that in mind. And also keep in mind that it's difficult to put a price on risk management. Sometimes we cut our gains short. We get out of the market and we sell, and if we do it for the right reasons, don't regret it. Even though the stock may go up, the market may go up, if you understand why you did it and your methodology was correct, it was for risk management, don't ever regret it. Don't ever regret doing that, because you can't. It's very difficult to assess a price on protecting against risk. The problem is you don't want to get into this excessive, exaggerated paranoia. Like many of these morons out there, these fund managers, they're still bearish and have been bearish for 3, 4, 5 years, and they're down, right? This is why you're hearing about all these fund managers underperforming, right? Let's say, well, Main Street's doing better than the pros. No, they're not, because Main Street's been listening to the doomsday guys. Main Street's not in the market. You think Main Street's in the market? They're not in the market. When Main Street starts getting into the stock market, that's when we should be concerned about the next bear market, okay? I can tell you right now, the vast majority of investors never got back in. They sold probably close to the bottom, and they never got back in because they were spooked out of the markets. And a lot of these fund managers, especially the hedge fund managers, they're not doing well because they can't time the markets. They're not that good. The media makes them sound like superstars, and the reality is they're stock manipulators, and they engage in insider trading. I can guarantee you they don't have market forecasting skills. Maybe a very tiny amount do. Very, very, very tiny. But consistently forecasting these markets, they don't do it. Can't do it. Now, some of them are good in valuation analysis, distressed securities analysis, and so forth. But market forecasting funds very rarely do well, and almost never do well over the long term. So that's pretty much it for this first video. I'm going to have a second video on the individual indexes, at least the Dow and the NASDAQ. Once again, there's really nothing new. The only new thing is that I'm going to talk a little bit about what this last sell-off might have meant. I'm going to consider some possibilities, and also I'm going to consider whether or not.
getting back as an investor, if it's coming down to here, almost irrespective of what's going on, I have to believe. If I have to make a call in advance, and of course I can change depending on what happens, but I have to believe this is where you want to start doing that 18, 17, around there. Their earnings report is a complete game changer, at least for quite a while. Bottom line, NVIDIA now is going to enter the realm of Tesla, Apple, and all these other big, I mean, listen, NVIDIA can come down to 150, come down to $100. If you don't think it's possible, then you don't understand how the market works. I mean, listen, NVIDIA can come down to 150, come down to $100. If you don't think it's possible, then you don't understand how the market works.